Hello from East Asia Econ. I'm here with the main macro market themes that we've seen developing over the course of the last week. Now, a spoiler first, we're not going to get into politics. And I think for many market observers, perhaps the politics has been the most important development over the course of the last week. Two things in particular clearly stand out. One, Xi Jinping going to the US and meeting with President Biden. And second, here in Taiwan, the two main opposition parties coming up with an agreement to present a unified candidate for the presidential election next year. Now, some people interpreted this as being a collapse in the geopolitical risk premium around China. Now, seems a little bit early to be reaching that conclusion. And in fact, pretty much as soon as the ink was dried, the agreement here between the opposition parties collapsed. I'm not sure that that's a particular surprise. You have two politicians, both of which want to be president, basically having to say that they'll allow the other one to do the job. Seems a bit of a tricky ask, I think. And in terms of US-China relations, well, it's a minefield going forward still, notably with the Taiwan presidential election in January and then the US election next year. So I think really hoping for a huge change in US-China relations still looks something which seems rather optimistic. In any case, we're not going to focus on those issues. I think we're going to focus instead on where we see the economy is going and what's happening with markets, where I think we can have a bit more conviction about what's going on. Now, to start off with, I just wanted to remind you that this is all part of the research we do at eastasiaecon.com. We publish something most days looking at the economies of China, Japan, Korea and Taiwan. We publish both cyclical research and also structural analysis. And we also have on the website hundreds of interactive charts which are updated daily when new data is released. All of those things can be found on the website at eastasiaecon.com. If you're interested in subscribing, then please do get in touch with me at paul@eastasiaecon.com. Now, with that out of the way, back to our main themes. And again, I had three things I wanted to be talking about. So the first is the export cycle. And the export cycle in Asia is particularly important for the smaller economies of Taiwan and Korea. They've been in export recession pretty much over the course of the last 12 months or so. Usually that would be a huge macro event for these economies. And so what happens to the export cycle really has a great deal of significance for thinking about where both the economies go and where the markets in these regions go. Now, there have been quite a few developments over the course of the last recent period suggesting that the export cycle is now lifting out of recession. So this week, we finally had the Japan data for October, so we can draw a sort of comprehensive picture looking at where exports in the region are. And on an average basis, year-on-year growth is now positive for the first time in a year. Taiwan listed company data for October also lifted, both for tech companies and for non-tech. And in Korea, the export data for October show that the DRAM price is increasing, and that's true also for the spot prices which are published by the Ministry of Finance in Korea. So all of these things are positive. In addition to that, we also publish some comprehensive indicators to try to look at where the cycle is going. Both looking at, one of those is looking at sort of more sentiment-based things. So that includes the ISM in the US and the IFO in Europe, trying to get a picture of where the cycles might be going. The second is more of a financial indicator-based model, which looks at sort of equity markets and the US dollar. Now, the first one, the sentiment-based model, has been improving, but it remains at very weak levels. The second one, the financial conditions-based model, has been improving much more quickly. And to be honest, at the moment, the export cycle looks much more engaged with that second one rather than the first, which actually suggests the outlook for exports looks quite strong. Now, that being the case, there should be some important market implications, in particular an environment if it means the US dollar is stabilizing and US rates coming down. So that implication, first of all, is what happens with currencies, and most notably for the Taiwan dollar, which is the most cyclical of the currencies in the region, most exposed to portfolio inflows coming back when the cycle improves. And so in this environment, I think it becomes much more reasonable to think that the Taiwan dollar should be appreciating. That's probably also true for the Korean won, perhaps not so powerfully. The second implication for both these economies is what it means for interest rates. Now, usually you would think if the cycles are improving, the domestic economies gain momentum, and that means that at least these central banks can't cut rates, And if anything, perhaps going forward, they might have to hike. It's a bit more complicated this time because we're in an environment where over the course of the last 12 to 18 months, there's been an unusual desynchronization between the domestic economies here and what's happening with exports. And so, in fact, although the export side has been very poor for the course of the last 12 months or so, the domestic economies have looked okay, unemployment has come down, and core inflation remains quite high. So going forward, it's really the interaction of the domestic side with the export side, which I think will determine where interest rates go. And that probably means that looking into the first quarter of next year becomes quite interesting if there is a big upturn in exports, because then when, again, coming out of an export recession, we're already in a situation where unemployment is low and there's not much slack in these economies. In that environment, there's more potential for interest rates to have to rise. And it's then, I think, that the central banks become interesting. So that's the first theme, export cycle recovery, implications of that. The second theme is all about China. Now, China has been basically on a different planet over the course of the last 2 years or so, economically speaking. The rest of the world's struggling with inflation, China struggling with something akin to deflation. Now, the data over the course of the last few days doesn't suggest that that is changing. So deflation in China, or at least very weak prices, I think still remains the main theme. Now, the reason for arguing that is basically because the property market remains so weak. So property starts in October fell to the weakest level since 2008. Property sales also fell again. Now, both of these things are quite significant, I think, both because the property sector is important for the economy, but also in terms of, I think there has been still quite some people arguing that what's happening with the property market is all deliberate. The government wants to get rid of property as a driver of growth because it wants things to be driven by more productive sorts of investment like semiconductors or high-end manufacturing or something. Now, as always, there is some truth in that, but I think it's difficult for me to think that back in 2021, when the government was thinking about the 3 red lines, it thought that over the course of the next 2 to 3 years that property transactions would fall by 50% or more. And I think given that, particularly since 2022, the government's been making a lot of efforts to at least try to stabilize the market, the fact that the market still continues to fall is something we should also be quite concerned about when thinking about the economy. Now, the other thing that this means is that property prices are falling. And in fact, in October, property price deflation was the strongest it's been in the current cycle. Now, on the official data, that's still only about 4.5% annualized. But still, it is the direction of change that's important, and prices in China clearly are still coming down. Now, property prices are only part of the equation when we think about overall inflation in the economy. The other things to be thinking about are CPI and PPI. Again, both negative at the moment. CPI, admittedly, that's a lot because of what's happening with food prices. But when we look at changes in household savings behavior, there's nothing to suggest that core inflation is going to be bouncing back very strongly from here. Equity prices in China have obviously also been very weak. And if we look at our overall measure of prices, it still remains pretty much as negative as it's been since 2008. So this brings us on to the market consequences of this. And I think the most obvious one is that interest rates in China still have further to fall. We have a model, sort of a simple model, but looking at the PBC's reaction function. And that suggests that the PBC remains very deeply in cutting territory because things like M1, pricing, construction activity all remain very weak. So I think it's very likely that the PBC continues to cut rates, and it's very likely that interest rates in China still have further to fall. Where it's a bit more controversial, or there's more room for discussion, is what it means for the currency. Now, a lot of people, basically, I think because the CNY has been weak, given where interest rate differentials with the US are, a lot of people have been saying or trying to argue that this means the currency is going to continue to weaken. And obviously capital outflows will be a problem for China and so on. But I think it's also worth bearing in mind that there are structural reasons to think the currency could be stronger. One of those is because China has this enormous trade surplus, which isn't just deep, it's also broad across a whole range of products. The second thing is because of this domestic backdrop of very weak inflation. Now, I think in that environment, it's at least arguable to be thinking that real interest rates in China are actually rising. We would have a test of that, or a better way of being able to update that sort of hypothesis, because the PBC usually publishes quarterly data which looks at consumer price and property price expectations. Unfortunately, in the third quarter of this year, that survey hasn't yet been released, so we can't update that data. But I think at least my feeling would be it seems quite likely that real interest rates in China are still too high. And given that backdrop of a structural trade surplus in an environment where potentially the US dollar is peaking out, I think it's reasonable to be looking for the CNY to appreciate rather than to depreciate. The third theme is Japan. Now, Japan is more complicated. I think it's something where I still have less conviction about where the markets are going to be going. The reason for saying that is the economy is still still quite unsettled out of the COVID recovery. Now, in a way, the GDP data that was released this week does reinforce the idea that monetary policy is working just as it should. Exports from Japan are doing quite well. They're doing particularly well in services exports, which is basically tourists going into Japan. And at least one of the anecdotal reasons for that, at least living in Taiwan and speaking to people here, is that people are going to Japan because Japan is cheap. So there is this consequence of the currency being weaker feeding into export growth being better. At the same time, the reason that one of the consequences of the currency being weak is that inflation, imported price inflation, has been very strong. And so as much as that's positive for exports, the other thing that monetary policy and sort of thinking about how monetary policy affects the economy, the other thing that this would mean is consumption would be weak. And we definitely are seeing that in Japan too, and perhaps even more so than we're seeing export strength. So in the data that was released this week, consumption wasn't just the lowest it's been since before COVID, it was also lower than at any time since 2014. So consumption really is very weak in Japan. Now, what does that mean? Well, we can hope, and perhaps with time, that this strength in some of the export sectors over the course of time will feed into domestic consumption. And there are some reasons to think that that can happen. So as an example, when you see the strength of domestic tourism, you would think that that means that hospitality employment is going to be increasing, the labour market therefore strengthens, wages can increase more quickly. And looking at hospitality employment in Japan, it's still below where it was before COVID. So there should be room for that process to play out. The problem is it's unclear, or it seems unlikely, that at least from a government perspective, the Prime Minister can wait that long. His popularity has been plunging, in part because of all this pressure that's coming from economic policy and the rise in prices. So there clearly is a lot of pressure on the government and on policymakers to do something about the weakness of the currency, feeding into the strength of inflation, which isn't being led by wages, and therefore that's negative for consumption. Now, what can the BOJ actually do about that? Well, when consumption is so weak, it still seems very difficult to think they're going to be in much of a mood to have very much tightening. So again, I think in Japan, unlike the other economies, it's more difficult to have conviction about where some of the markets might go. So, in terms of summary of where we are, I think these three themes strike us as being particularly interesting at the moment. One, the export cycle in the region. It does look like that's now improving. If that's the case, then we should expect to see particularly the Taiwan dollar, also some of the other currencies appreciating on the back of that. The risk around that is obviously still what happens with the direction of the US economy, but it does look at the moment that that's the direction things are going to be going. The second theme, China. For China, it still looks like deflation, or at least very weak inflation, is the theme. And what does that mean for markets? Probably still that the PBC is going to be cutting interest rates, and that probably still means that market interest rates in China have further to fall. I tend to think that the currency doesn't necessarily need to be weak in that environment, but to test that hypothesis or to have a bit more ability to monitor where we are, having some more data from the PBC would be useful. The third theme, what's happening with Japan. In Japan, I think that the very strong macro imbalance is in this big weakness of consumption. And as long as consumption is so weak, it's very difficult to see how the BOJ can move aggressively in terms of policy to engineer the sort of cyclical rebound in the currency, which should be possible given the cheapness of the currency at the moment. Now, that's all for today. I want to say thank you very much for listening. And just to remind you again that this is all from the research we do at eastasiaecon.com. We do a bunch of stuff every day. All our charts are available on the website. And again, if you're interested in subscribing, please get in touch with me, paul@eastasiaecon.com. Thanks very much for listening.